if you had leveraged up investments in just common stocks, and you'd figured a way so that you would have staying power if there were any market dip. I mean, you'd obviously obtain extraordinary returns. I pointed out in my investing lifetime, an index fund would do 11%. Well, imagine how you'd have done if you'd leveraged that up 50%, whatever the prevailing rates were over time. So a leveraged investment in a business is going to beat an unleveraged investment in a good business a good bit of the time. But as you point out, the covenants to protect debt holders have really deteriorated in the business. And of course, you've been in an up market for businesses, and you've got a period of low interest rates. So it's been a very good time for it. My personal opinion is if you take unleveraged returns against unleveraged common stocks, I do not think what is being purchased today and marketed today would work well. But if you can borrow money, if you can buy assets that will yield 7 or 8%, and you can borrow enough money at 4 or 5%, and you don't have any covenants to meet, you're going to have some bankruptcies, but you're going to also have better results in many cases. It's not something that interests us at all. We are not going to leverage up Berkshire. If we'd leveraged up Berkshire, we'd have made a whole lot more money, obviously, over the years. But both Charlie and I probably have seen some more high IQ people, really extraordinarily high IQ people, destroyed by leverage. We saw long-term capital management where we had people who could do in their sleep math that we couldn't do, or at least I couldn't do, working full-time at it during the day. And I mean, really, really smart people working with their own money and with years and years of experience of what they were doing. And it all turned to pumpkins and mice in 1998. And actually was a source of national concern, just a few hundred people. And then we saw some of those same people, after that happened to them once, go out and do the same thing again. So it's, I would not get excited about so-called alternative investments. You can get all kinds of different figures, but there's probably at least $1 trillion committed to buying, in effect, buying businesses. And if you figure they're going to leverage them, 2 for 1 on that, you may have $3 trillion of buying power trying to buy businesses in the U.S. market, maybe something over 30 trillion now, but there's all kinds of businesses that aren't for sale in that thing. So the supply-demand situation for buying businesses privately and leveraging them up has changed dramatically from what it was 10 or 20 years ago. And I'm sure it doesn't happen with your Winnipeg operation, but we have seen a number of proposals from private equity funds where the returns are really not calculated in a manner that, they're not calculated in a manner that I would regard as honest. And so it's not something. If I were running a pension fund, I would be very careful about what was being offered to me. If you have a choice in Wall Street between being a great analyst or being a great salesperson, the salesperson is the way to make it. If you can raise $10 billion in a fund and you get a 1.5% fee and you lock people up for 10 years, you and your children and your grandchildren will never have to do a thing if you are the dumbest investor in the world.